Raise your hand if this is your first time at CPAC.
Come to CPAC. If you haven't been here before, get the program and see all the stuff that's coming around. There's a lot, yes. Right. How many people here are at CPAC all the time? Yeah. It's a good thing, isn't it? Real good thing for this community. CPAC's a really good thing. I don't know how many times we could see some cover band do the Eagles, but I'm sorry, again? Oh yeah. Yeah, and isn't it the food in Agave is like half price before the concert? And I don't go to the concert. I just go and eat. And you get like prime rib for $12. Yeah. $5, yeah, you get the, yeah. The casino's great. I love it. Is there anybody here who volunteers for Friends Indeed? One? Do I only have one volunteer for Friends Indeed? Okay. Keep you in mind. Did you drop everything? It is my fault. I'll take it.
Oh, well, thank you.
Did all of that come in on the microphone? You guys know we do your shredding for you? We do your shredding, you bring your shredding. One banker's box or less per month, please, if you can. But this Thursday, they're coming out and doing a special. Like extra, they know they're doing extra work. So for the next couple of days, and I think they'll be there by like 10 o'clock on Thursday. So tomorrow, if you've got some stuff you want shredded, bring it tomorrow. We do your notary for free. Dion's a notary, I'm a notary. You should be a notary. It only costs like 120 bucks. You can't make any money on it, and the insurance sucks, but then, you know, you can sign stuff. The handout. No problem. If you didn't get one of the handouts, that's going to be okay. The information is, I think I'm going to put it on screen too, so shouldn't be a big deal.
Good, you?
But you might like the handout.
Yes, sir. You took it off every year.
Does it?
Okay.
Maybe.
We go off.
Hi, John.
No, hey, go in the back where it's dark. You remember the movies when we used to go to theaters? Back in those days.
I remember at the theater in Eloy, Arizona, a young person could get in for $1.25. So on a Saturday morning, we'd go through the neighborhood and see if we could get glass Pepsi bottles. The quart ones were a quarter, you know? And you go and see if you could collect Pepsi bottles from people, and they kind of knew who would come around, right? You come around to people, be like, yeah, I got a couple bottles for you. Make enough money, get like $2, and get popcorn and a movie ticket, and be in there for a double feature all day. Yeah. Now you can't rent on Netflix for $1.25, you know? And there's no chair, nothing. Nothing. The last couple people are. Is there anybody in the audience named Mike? How you doing? Mike check done. Okay. Mike's doing great, for anybody who's wondering. Are there? Are there? No? We just got the one Mike? Maybe they don't want to be known. Trying to keep it secret. Let's check out there one more time. I think we're about ready to start. I know I put it somewhere. No, that's okay. Hey, how you doing? But no luck. Yeah, that's a good idea. She could have done it. So this guy is standing in the line at St. Peter's gates. And St. Peter says, tell me how you died. And the guy says, I got the electric chair. For killing a guy. St. Peter's like, man, that doesn't look good. And he goes, well, let me explain what happened. It was righteous. It was this rage thing. I thought my wife was cheating on me. So I called her from the office. I said, honey, I'm going to be home really late tonight. Might not even be home tonight, but maybe tomorrow. Don't wait around for me. Then I got my stuff together, waited about an hour, went home. I get there, open the door, my wife screams, dinner table set for 2. Why is the dinner table set for 2? I'm not coming home that night. My wife was barely dressed. Why is my wife barely dressed? So I start raging through the house. I go check the closets, nothing there. Look under the bed, nobody there. Check the other rooms, nothing there. Bathroom, nobody there. Go looking all over, can't find the guy. We live in an apartment, 7th floor. The guy's not around, I can't find him. I go looking out of the balcony, and this naked dude is running out of my building. In a rage, I get the refrigerator, pull it to the balcony, throw it off the refrigerator, hits the guy and kills him. Murder, they give me the electric chair. St. Peter's like, oh, pretty crazy story. But I think I can, all loving God, I'm going to go ahead and let you in. Come on in. Next guy comes up. St. Peter says, how'd you die? The guy goes, weirdest thing, craziest thing. It's about 6:30, 7 o'clock in the evening, get ready to do my run, put on a pair of shorts, hit the building, start going, boom, dead. No idea how it happened. Dead. No idea how it happened. I was not even maybe 50 feet out of the building when I died. I was like, okay. We're gonna let you in, come on in. Next guy comes up. St. Peter's like, all right, man, this is a fun day. Tell me how you died. And the guy goes, okay, are you with me? I'm hiding in this refrigerator, see? And thank you all for attending today. My name's Joseph Lessard, in case you don't know. Did you meet everybody? Did you meet Dion and Sherry and Kathleen and Darlene and my people? I have the best staff in town. I think some of you people will attest to that. They are great. They are great. If you need anything, a lot of times the stuff that we deal with isn't a tax return. Someone will call us about a notice they get from the county about their property taxes or some form that's going to change your withholding or something having to do with your insurance or something like that. You can go on the internet and try to find it. I can't guarantee you we will always have the answers. But the longer the firm is around, the more we experience and the more likely we've touched something that you might touch. So start from peace of mind. Say, hey, I don't know what this is. I'm going to call Joe's office. I'm going to ask them if they can give me any kind of guidance. And there's a bunch of ways we can help you. If we don't know what it is, maybe we look it up faster than you do. And maybe we know the terminology a little better than you do. So don't stress when you can just make a phone call. Make a phone call. Does that make sense? Everybody with me? My staff will help you as much as they can. I am incredibly difficult to reach on the phone. So I'm hoping you all will understand as we go forward, if someone calls and says, I just need 5 minutes of my time, of Joe's time, we're gonna book the call. We're gonna put it on the schedule because what happens too often is it ends up on a little, like half a sheet of paper that gets put kind of on the end of my desk to call Dave. And it's not on my calendar, and I'm going through my day, and it's not on my calendar. And then someone puts something on top of the call Dave piece of paper. And then the piece of paper to call Dave ceases to exist. And I never call Dave, and I feel terrible. So please, please, please have patience with us, bear with us. We're gonna make an effort to try to make sure that everybody who needs a call gets scheduled, so we make sure that we call you back on time. Dion, did you have something you wanted to say? Does everybody know Dion? Best front desk person in town. Best front desk person in town. Okay, so the things we're gonna do, that's the introduction. We're gonna go over preparing for tax time and what we need. I think you guys do a lot of work you don't really have to. So we're trying to make it so that when you get ready, I want your time to get ready for tax season 1 hour or less. I want you to have to do 1 hour or less. So we're gonna do as much as we can to try to get you to that. Most of you should be able to gather everything for my work in 15 minutes. There's probably things where you're going, no, I gotta go get this thing, that you probably don't. So we're going to go over that. I just kind of want to make it a little easier for you on that. We're going to talk about the Arizona charitable tax credits. There are very few beautiful things in any tax code in any municipality in the United States. The Arizona charitable tax credits are beautiful. They're a marvelous tool that we can use. Most Arizona residents can satisfy their tax liability by making a charitable contribution to Friends Indeed. Should we be making charitable contributions to Friends Indeed? Absolutely. If you don't know the benefit that Friends Indeed does in this community, look 2 people to your left, 2 people to your right. One of those 4 people will be able to tell you a really good story about how Friends Indeed has helped them out or somebody they know. Friends Indeed is awesome. We're real happy to give them charitable contributions. This year, for a single person, it's almost $500. For a married couple, it's almost $1,000. And most Arizona taxpayers don't have a tax liability that high. We'll go over that again. Real good thing. Real good thing. We don't want to pay the state of Arizona. We want to give it to Friends Indeed or the food banks or Gospel Rescue Mission, a bunch of other places. We're going to talk about itemized versus standard deduction. Who wishes that they could itemize? Raise your hand if you wish you could itemize. You do not want to itemize. Nobody wants to itemize. It costs, you know what you got to do to itemize? You got to spend a lot of money. Right now, the standard deduction for a married couple is $30,000. A single person is $15,000. So how much do you have to spend on deductibles to itemize? Over $15,000 or $30,000. Yeah, cool, great. We live in southern Arizona. It's hard to do that if you're a healthy person. So you probably don't want to do that. And then I'm going to get a couple of minutes about some stuff going on with the tax laws. There's not really any big deal. Not really a big deal. We're going to do a lot of that. Okay. So, I'm going to go back. Generally, when we're doing the tax return, the thing that makes things difficult is massive amount of documents that say the same thing that one document says. So, like, the time you go, oh, I'm going to get together all these receipts and then write the number on here. We don't need the receipts. Don't take the time to put it together. It doesn't do you any good. Most of my clients do not get to deduct medical because they don't have enough medical to beat the standard deduction. But if you are deducting medical, the very easy way to do this is in January of the year, before you give me your stuff, you call your doctors. You say, hey, get ready to see my tax guy. How much did I pay you out of pocket last year? And their front desk person, Marcia, Dave, I don't know who, click, click, click. Don, you sent us $550. Cool, $550. That is much faster than going through receipts. How many doctors would you call? 5? Maybe 10 in a really bad year? So, with this in mind, you don't even have to save the receipts at the beginning of the year. If you go through a standard year and you're basically healthy, then you know at the end of the year the receipts aren't going to matter because you're not going to have enough medical expenses to itemize. If it is a heavy year, you get to December, you call your doctors, you say, hey, how much did I give you? They're going to tell you exactly how much you paid out of pocket. Let them look it up. They have software. It'll do it for you. Does that make sense, what I'm saying there? Right? Or maybe like you had a real heavy medical year, and you're going to see that doctor that you've seen a bunch of times this year. Say, hey, can I get a statement that shows me what my out-of-pocket was? Like you would do that in November or December. All the doctors that you're seeing, find out what you paid out of pocket for that year, add in your last couple of visits. That way you're not going through credit cards, you're not, where is that invoice from that day? How much did I spend? They know what your out-of-pocket is. Does that make sense? Okay, there's this guy, Cohen, and the IRS went after him because he estimated his mileage. He was a salesman, and he estimated his mileage. And the IRS went after him, said, you're not allowed to estimate your mileage, you got to do a little mileage book. And he took it all the way to court. And the tax court said, you know what? Maybe you should be able to estimate your mileage. So what we have is this thing called the Cohen rule. And the Cohen rule allows a taxpayer to use a reasonable estimate for any deduction on their tax return. So my example of a reasonable estimate is, how much do you pay a month for prescription drugs? Something. That times 12 is what you pay for prescriptions. Does that make sense? Now, I have people who will hand me a sheet of paper that says something like, January 6th, trazophalomazidone, 100 milligrams, $7. January 19th, flamingojane, this many pills, this much. You don't have to do that. You don't have to. Is that the bottle $9.85? Call it 10. The 15 cents, how can I help you? I'm an IRS agent. I was looking at your tax return. I think you've misjudged your prescriptions by $4.18. No, it's never going to happen. It's never going to happen. So with that in mind, you can kind of do a thing. Like with your mileage, you're going to sit there and do like, where'd you go? I went to Tucson. I went to Northwest Hospital, about 40 miles. How many times did you go? About 100. Okay. 4,000 miles. The chances that they're going to be able to come and audit you enough to change the return is incredibly low. The way an audit works is somebody at the system goes up there and says, I'm going to audit 85614. I want everybody in 85614 who's getting a deduction for medical and owes more than this much money. Okay? And they put that in the software. And then the software would look and say, here's your set of people that we might audit. And then they go, what are the ones where we'll make money? Because if they're going to look at it and go, we could audit this return, we would change it, and we're going to make $100, they are not going to audit you. It doesn't do them any good. They have to present to management. They go, we're going to audit Dave. And we think if we successfully audit Dave, we're going to make $5,000. And then the manager goes, cool, go audit Dave. You can't go up and go, we're going to audit Lydia. And if we're successful on this, we're going to make $18. No! We had, they hired some new guy, a bunch of people probably heard the story already. They hired these two new guys at the Arizona Department of Revenue in 2020. And they went in and they hit this thing, and they basically said, if you live in 85622 and you took a medical deduction, we're going to audit you. Do you think many residents of 85622 take a medical deduction? Anybody who's in a facility, right? Anybody who's got a caregiver, full-time caregiver, or anything like that, big medical. So 150 clients, 2016 and 2017 for most of them. So there's one person after another coming in with a letter. They're auditing 2 years, they're auditing 2 years, they're auditing 2 years. So I'm looking at it like, what am I going to do here? And then we start running them. I'm like, okay, so if they audit this one, what do we got? This person doesn't have anything. They could completely disallow every deduction on this tax return, and the result would still be zero. Okay. And something like 95% of the audits that we got were like that, where they had just put the wrong numbers in their little audit filter thing. So they were going to audit a whole bunch of people. We ended up sending Arizona Department of Revenue a letter that said, we need you to take another look at this. Here's our examples. Here's all these people that are like, and the ones I have, look, they're all in La Posada. They pay this much money. And any other ones you want to look at. And we had two that ended up, we had to like actually provide supporting documentation and go through the audit. And of the two, one of them, the audit resulted in a change. The taxpayer was like, by the way, I didn't really tell you about this stuff. Okay, now they're gonna get it, so we do that and all. But like to get to that, like for them to audit, they have to make money on it. And they have to make a lot of buck, right? They don't get to throw you in jail over $1. Do you know what it takes for the government to throw you in jail over your taxes? Anybody want to shoot a guess? What does it take for the government? What do you have to do that the government will throw you in jail over your taxes? There's two things, and only two things that will get you in jail. What are they? Don't pay your taxes is the big one. The other one is egregiously violate the law. If you don't egregiously violate the law, then they send you a letter. Has anybody got a notice of change ever? Where the IRS is like, hey, we got your tax return. There's a little difference. We think it kind of looks like this. Are we all good? You get a notice of change, and it'll say something like, you didn't report the interest from this Bank of America, and it's $35. So you did your tax return. We think you owe us another $7. And then that's an audit. That's them looking at what you sent them and comparing it to what everybody else sent and saying whether it's the same or different. And they send you your letter. Like, oh, okay, I owe them $7. Pay them $7 and you're done. Right? Because they got their money. Now the person who goes, I don't owe them $7, and I don't owe them $7, and I don't owe them $7, and they say, we're going to take your property, and you say, I don't owe them $7, and then they say, we're going to take you to court, you go, I don't owe them $7, they say, please pay, and you go, no, fine, you're going to jail. But they just want the money. All of them. Arizona Department of Revenue just wants the money. Internal Revenue Service, Department of Treasury, they just want the money. So that whole, like, what did the lady say? She was on her way out the door, 82-year-old La Posada resident. Thank you for keeping me out of jail. What are you doing? Little black market La Posada, sell your diabetes medication. I don't think that's what's happening, but I was like, well, what do you do? What are you doing? No, come and tell me. What do you do? She goes, I'm not doing anything. He said, you keep you out of jail. I'm just a lawyer. You're doing your thing to keep you out of jail. Don't act in a manner that would cause you to possibly go to jail. That's the best, right? Don't do things that will get audited. But it's gonna happen. Anyway, so when they audit, like, they know the Cohen rule is in effect. So, you know, you're sort of going, I paid about this much. I've never had an audit where I had to prove 100% of medical. When I get to 80%, they go, fine. That's fine. What they're looking for is they're gonna be like, how much did you do in medical? 45,000. Show me the receipts. Like, and I got, okay, here's about 15,000 of receipts. Go, where's the other 25,000? Oh, it's this nose surgery I got. I had a rhinoplasty done, and it's not deductible. Right? Elective cosmetic surgery is not deductible. So that's the kind of thing they're gonna catch on an audit and come back and disallow. But if you're just showing them, here's my drugs, here's where I went to the doctor, here's my miles, you're gonna pass every audit. You don't play around enough to cause any kind of problems. Does everybody understand that? Does anybody have a question about that? Cool. So we use estimation for a lot of things. Do me a favor, don't estimate to the 100, estimate to the 10. I love my hands like, you really want me to put this on the tax return? Go, yeah, so it's a little business. What did you pay for insurance? $1,000. What did you pay for rent? $15,000. What did you pay for something? $100. Like, everything is these even numbers. Fake. If you're gonna lie and say 100, lie and say 99. Lie and say 103. Don't do that. Don't be like 100, 100, 100. Letter-sized pages. I so very much appreciate everybody trying to conserve paper. It is hard to scan a Post-it. I got a lady, I swear, she gets everything she can out of an 8.5 by 11 by tearing it apart. So I get these little bits, and they're like paper clipped, and I was like, where is the note for this? If at all possible, 8.5 by 11 sheets. I give you an organizer. Flip it over right on the back. Real easy, right? Right on the paper that I give you if I can. Put it on the organizer if you can. On the organizer, there's a place that says for prescriptions and all that. And there are 4 people in here right now that are going, I know he wants me to do that, but I like to give him the little letter. And I'll say, okay, it's not best. It's not ideal. You can use the organizer and summarize the information a lot better. And one of the things that we run into is when there's conflict, like most common conflict. The copy of, no, on the organizer it says you made a charitable contribution. Here's a copy of the check, here's a copy of the letter, here's a copy of the receipt. 4 contributions or 1? I think it's, check the dates, that's a couple days later. 1, okay, 1. And I should be able to go, 1 contribution, go. So duplicating the information in an effort to make it more clear to me actually muddies it up. Because I gotta look at both. We have to look at every document. So you're like, I'm just gonna give him this. I gotta go through that because somebody's gonna write on the 19th page of this, solar. Oh, there's the solar, they got tubes or something. So the important stuff on, out there where we can really see it, don't bury. And please, if possible, don't be redundant. I know you think it helps, it doesn't. It really doesn't. And I can always ask. Give you a call, say, hey, call them about this. We want to know a little bit more information. But if we get too much, we end up looking through, this conflicts with this, these dates don't look right, I gotta re-add this, it gets to be a problem. So we'd appreciate it if you could avoid that. Staples and envelopes. I think you may have noticed, we don't put stuff back in the envelopes anymore. We used to take it out, copy it, put it back in the envelope, take it out, copy it, put it back in the envelope. We don't copy anymore is most of it, because we just scan everything now, just to try to keep the costs down. So we take it out of the envelope, we don't have the time to put it back in. So if you send it to me in the envelope, I'm gonna take it out of the envelope, we'll throw the envelopes away, you're just gonna get your papers back. Let me know if that's not working for you. Talk to Dion, say, hey, sorry, that's not Dion. Talk to Dion, say, hey, We got to do this in a certain way. We'll do what we can to accommodate, but it's not helping us to do it, take everything out of envelopes to have to pop staples and things like that. Does that all make sense? Any questions? Okay, cool. Now we do the fun part.
Uh-oh.
All right. Actually, pretty good. So, Arizona charitable tax credits. What is, yes?
So can you, if I scanned everything in and gave you a thumb drive, that would be okay?
Yeah, that's good. Now, so you're going to take the document and you're going to do one more step in the process to give it to me. Why not just give me the doc?
I like the scan.
Okay, cool. That's your choice. That's your choice. That's your choice. Like I said, I'm going for easier. But who have I told? Life drives? Does anybody in here has heard me say life drives?
Yep.
We make our decisions about what we want to do. I want it this way, I want it that way. Life drives. What's important to you is what matters more than anything else. So if that's how you want to do it, we'll accommodate. No big deal.
A question here.
Yes.
I have one of those little portfolios that they send me these big things and it's supposed to tell me how much is taxable and where my they invest in foreign. I have no idea. I don't know what part of that to send to you.
Whole thing.
The whole thing.
The whole 1099 they sent you, yeah. How many people in here have Edward Jones? Edward Jones, okay, that's good. How many people are BC? Okay, Edward Jones statements, awesome. Every little piece of information. They go, here's the foreign tax, and here's what you got in foreign dividends. Here's what you got in all this interest, and this is the part that was from the government, and this is the part that was from the state, and this is the part that's from the state you live in. Beautiful, super detailed. Go right in. Oh, they got this muni bond fund. How much of that is Arizona? 17% is Arizona. Cool, bang, right through it. RBC, nothing. Nothing. They're like, they made money. Like, okay, and like the interest is on page 1 plus what's on page 7. You take out this thing on page 8. Yeah, and I'm going. So like the clients, I get a new client. Like, who do you got? They go Vanguard. I go, oh, you know. Okay. Can you guys switch your stuff to Edward Jones? There's marvelous Edward Jones people in town. John, Jeff, great people. Go to Edward Jones if you can. So those statements, we offer. Most people don't take us up on it. Some of them do. If you do not know how to read your monthly broker statement, give us a call, schedule 30. Bring one in, PDF it or print it out, and I will show you the roughly 3 pages that you have to look at to see what's going on. Because there's going to be a whole bunch of detail, but they're going to summarize a couple of things that if I called them, I said, hey, I'm getting to work on this person's tax return, or I'm going to do some planning. Could you tell me what their interests are, what their dividends, and what they got going for capital gains? That's on a couple different pages in your statement. So if you're not sure how to read that, print one out, make a call. Hey, Dion, can you give me 30 minutes? I just want to learn how to read my statement. I want to do a class on it, kind of. But have a look, because then you're going to find, oh, it's this thick. And go, yeah, you look at page 1, page 9, and page 14. And that's it. Did you have a question? You're scratching. Okay. We'd be happy to help you with that. You should know. You should know. And I think there's a complexity to those statements that you kind of, I think I'm making money. Okay. But I think that you should be able to look, especially for, all right, we charge, right, what you pay me for a tax return, well under $1,000 for most tax returns we do. By like most, I mean all but maybe 20. I'm pretty sure the finance guys make more money than I do. You should be able to call them and say, how am I doing? And they should answer. And if not, you should be able to say, I have my statement in front of me. Can you tell me which page I can look on to see how I'm doing? And I think for what you pay them, they should answer. If they don't, I will. Feel free to make an appointment. Going back, Arizona is a low income tax state. What's the most common tax rate in the state of Arizona? 2. Capped at 2.5. 2%. This is one of the lowest state tax rates. California, 10. Most of the places around between 7 and 9. Arizona's 2. Arizona does not tax Social Security. So the income number is even lower, and the tax that taxpayer pays is an even lower number in Arizona. So if you're an Arizona resident and your taxable income, you're a married couple and your taxable income your federal taxable income is under $100,000, and you're here, so I'm assuming you've got some Social Security, your Arizona taxable income is under $75,000, and your tax is less than $1,500. And that's at a fairly high income level. That's well above the average. So if your tax is like $1,500 or less, you can satisfy the whole thing with charitable contributions instead of sending money to the state of, to Maricopa County. If we send $1,000 to Maricopa County, how much does Green Valley get back? If you got us $2, you're good. We estimate about 4 cents. We think it's about 4 cents. We don't have a city government that's going up to the Capitol and saying we need money for roads or anything. Like, all our representation is county representation, and we are a very small part of a big county. So we don't have a lot of pull here in Green Valley. So if we can do things to keep the money here, that's better. That's why I don't want to send it to Maricopa, because send it to Maricopa, Tucson's going to get it, Phoenix, Flagstaff, Yuma, we're way down on the list. Most of us don't owe enough to have to worry about it. So what we're looking at then is, this is my Arizona Department of Revenue website. This is, if you Google Arizona tax credits, it should take you here. And we got a really good mix. This is all our QCOs and QFCOs. That's food bank, foster care organizations, Friends Indeed. People, the rule is you have to help needy people. TANF, temporary assistance for needed families. So the Animal League isn't a qualified charity because it's animals. Positive, there's something that's animal related. I think it's called Positive. I think they're on the list, but they provide animals to people, something like that. Public school tax credits, $200 for a single person, $400 for a married couple. You just go down to Continental or Walden or something and say, would you take my money? They'll take it, you get credit for that. We've got credits for contributions to certified school tuition organizations. And certification, that's so that you file so that you can actually get the money. Do you guys know what this thing is? The vouchers, the school vouchers, a lot of controversy. Public school and the voucher program, huge credit in Arizona. The most you can do for qualifying charitable organizations, there should be a handout. Does someone have? There's a handout that says that starts off credit for contributions to qualifying charitable organizations. So we're looking at that for 2025, single person $495. I also included a little list. It is the list of organizations that's certified is like 32 pages. So we peeled out the Southern Arizona ones. My mom lives in Arivaca, and she's big on the Arivaca Action Center, so that's why it's the first one. So if anybody would contribute to the Arivaca Action Center, I would very, very much appreciate it. You get me into some good graces with a lady that can be grumpy sometimes. Next page, we got some others: Sahuarita, Green Valley. What do we have on here for Green Valley? Iuta, Friends Indeed, Valley Assistance, Hands of a Friend, Parkinson's Support, Sahuarita Food Bank, St. Vincent de Paul, Temple Emmanuel, Salvation Army, and United Community Health Center. And then Sahuarita Food Bank, a couple other things. So you can get this mix of contributions, right? So like married couple, they take $987 over to the food bank, and they take $400 to the school. That's $1,400 towards their Arizona taxes. Most Southern Arizona residents don't have $1,400 in Arizona tax liability because the tax rate is so low. Does that make sense? So it's a little extra work. Now, one of the things that I talk about, like, I'm hoping most of you have been in the office, and I've done the whole ranty thing, so you kind of know that our income, a Green Valley resident tends to have a pretty steady income. It's Social Securities, retirement, investment. If there's a business off to the side or a rental or something, it either tends to be steady so we don't have to worry about it too much, or it tends to be so volatile that we're doing a lot of estimated tax payments. But if your income is essentially steady, then the tax you pay 1 year to the next is basically the same. So if my income 2 years ago was $50,000, in Arizona, I'd owe a tax about $200. And then the next year, income's about $50,000, tax is about 210. Next year, the income's 52,000, goes up a little bit for some COLA, taxes 220. Does that make sense? Income doesn't change, tax doesn't change much. You with me on that? Okay. So if we go into a year and I go, like I do the tax return, finish the tax return, I say, you owe Arizona $800. Then you look at it and go, all right, next year, what do I do? So, well, how much did you pay in taxes? About $800. So, okay, go make a $750 charitable contribution to the food bank. That's gonna cover most of your tax. And then when I do the tax return, I'm gonna say you owe Arizona $50. And you just send Arizona the $50. That the $750, if your income goes down a little bit, the charitable is gonna cover it. If your income goes up a little bit, the charitable is gonna cover most of it. So you don't wait around and say, tell me how much, you pretty much figure out every year, this is my steady contribution amount because this is what covers my Arizona tax. Does that make sense? So if you need help with that, go back, take a look at your tax return, take a look at your Arizona, see if there was any balance due, any liability. Give us a call, say, hey, can I get 30 minutes? I want to go over this Arizona thing. Tell me what I could do. I'd rather give my money to the food bank than to Maricopa County. Yes, bunch of questions. Cool.
You have tax credits for your Arizona taxes. Did you pay more than the 987?
Uh-huh.
Does that carry over for several years?
No, you only get, so let's say you paid, like let's just say you paid 1,000. You know it's 987, easy check, I'm gonna write it for 1,000. If your Arizona liability was 987 or more, the credit would offset it. If your Arizona liability was less than 987, whatever was available, whatever you didn't use, that would be available to the next year. But it's only up to the amount of the credit that you could have used in the given year. We can see it. Wait, let me.
Churches in
No, they're not.
the whatever conditions churches not.
It's not. I don't know what has gone on with that the churches are not allowed to certify. What tends to happen is then organizations will like break off a component and make that its own charitable. Like you guys were trying to do like a little food bank thing or a little eating kind of thing. That kind of thing would probably be the kind of organization that could qualify, and then the church tends to say, make your contributions, if you want that credit, make your contributions to this. That's an organization that we work with or support. It's a little complicated, but because they're not, Arizona will not let you make a church contribution as a qualifying charitable. Too much politics to it. Someone over there. Yes, sir.
Humane Society.
No. Animals. Yes.
Last year, we had our taxes done with you, and I talked about the produce rescue, Borderlands,
Sure.
and they are a taxable.
They are a qualified charity.
Yeah, at the end of the year, you can make a low payment and you get your receipt, but if you do it the right way, you order ahead of time, get the email back from them that states you need a $25 or whatever donation, so every month or every time you go, you've got all your documentation.
Sure.
And you can
The
also-
little things that we do, right? Right, they totally accommodate it. They take the charitable contribution. I'm a member of Rotary. The Arizona Rotary Vocational Fund is a qualifying charitable. I'd appreciate it if you'd send some money to that. They're all really good. When we get out of those, because like public schools and the local organizations, you're gonna get, if you're a single person, $700. If you're a married couple, $14. One voucher credit is $1,500. You can almost get $3,000 if you'll contribute to the voucher system. People have political feelings about it, one way or the other, voucher versus public schools. It's nothing like the 7,000 that they're talking about in other places. They might head in that direction, but it is the biggest charitable contribution credit you can get as an Arizona resident, is paying to help some kid go to school. I offer no political opinion about it, I'm just letting you know about it. Does that make sense? Right? So what I tell my clients is, let's find out, what is your tax liability? What's your Arizona liability for the year? It's probably gonna be less than $2,000. If it's $2,000 or less, let's figure out how much of that we're gonna take care of every year just by making these charitable contributions. And then if you have a little shortfall, you send it in. If you're a little over, hopefully it's just a little. Have we done the thing No Perfect? Have I talked to you guys about No Perfect? Okay. So in life, one of the things we talk about in the office, and it has a lot to do with my golf game, is you cannot be perfect. Human beings cannot be perfect. We are absolutely imperfect. Every system we create, everything we do has a portion of imperfection in it. So with that in mind, there's a built-in mistake. Like, you're not gonna be perfect. What mistake do you wanna make? When should I invest in this? When should I move into La Posada? When should I do this other thing, that other thing? How much should I put in? What we're looking for is to avoid when. You're gonna put it in too early or too late. You're gonna put in too much or too little. But if it's a little too early or a little too late, if it's a little too much or a little too little, darn it, I should have invested more in Bitcoin, right? You don't want, oh, I did that way too late, right? Oh, I did way too little. Pay way too little in estimated taxes, you get a penalty. File your tax return way too late, you get a penalty. You do it a little too late. So as we're working on things, we're trying to say, if we're off and we're like, it's by a little bit, that's probably okay. It's real hard to try to hit that perfect. We're human beings, only one. So it's, it can be real difficult. So don't worry too much about trying to get like perfect on your tax credits and stuff. Get an idea about how much. I do about $1,000 a year. Do about $1,000 in charitable contributions. Some year it's a little much, some year it's a little more, but generally it works out okay. Any questions about the Arizona credits? If you didn't get the handout, there's one out there, AZQCO or Google Arizona State Tax Credits, and you're going to get to this website, and it's going to show you all the links, and it'll also get you to the lists of the company or the organizations that qualify. Let's see if I got it done. I don't know if the lists are contributions. Let's see if I can find the list real quick. So I'm going to go QCOs. No, not showing me the list. Okay.
I have a question.
Yes, ma'am.
Sorry if I missed it in your talk.
That's okay.
You talked about making the charitable contributions. So next year I come to you and I owe $100 to Arizona. Can I instruct you to fill out the forms that I will not pay you, Arizona, I will pay the check to Friends in Need, or it has to be done ahead of time?
No, actually, so in going back to that, there's very few things in any tax code anywhere that are beautiful. Very few things. Arizona lets you make the contribution up until April 15th. So the idea is that I'm going to do the tax return. I'm going to call you up and say, you owe Arizona $175, and you say, I'm going to go over and make that contribution. This is such a pain in the ass.
Oh, okay.
I got a guy, won't do it until, and I'm like, man, it's about $300 a year. It's about $300 a year. Just do your $300. How much is it this year? $273. You're gonna write him a check for $275? No. $273 to the food bank. Like, come on. But some people. So that's why I kind of think, like, if you're gonna do it, just to make it easier, you sort of figure out your base. You go, I'm gonna contribute 90% of what I owe every year. It's about the same. I owe about 1,000, so I'm gonna do about 800, 900 every year. There's some year I'm gonna come out 100 short, some year I'm gonna be 50 short, some years 200. But I'm in that kind of range, and then I don't even worry about it anymore. But that's generally, but we will, like, especially if you've done one previously, pretty much the last thing on the return is us making a call or something saying, we got it basically done. You owe Arizona $275. Last year you made a contribution. Are you gonna do that again this year? And then, yeah, we do. So then we take the tax return, redo it, pull the part out, and all that. And it helps us out a lot. Like on a 90-minute prep, 5 minutes of it can be redoing that tax return. And rather redoing it for that, I'd rather look at it deeper and see if I can make more sense out of where the numbers are going. So it's helpful for us if you do that during the year, know where it's coming, make your charitable contribution, and in the end, what you already have. Does that make sense? Does that make sense? Yes, sir.
In the same vein, keeping things easy, if you have withholding to pay the Arizona tax, and you know you're gonna do that, where you're gonna make a contribution, should I stop doing the withholding?
Absolutely. I very strongly advise that if your Arizona tax liability is under $1,500, do not do withholding. Get the withholding out, make the charitable contribution. So the withholding, I do the withholding, I make the charitable contribution, Arizona sends me, what?
Yeah.
Get that out of it, and then you just take care of it there. That's absolutely the way to do it. Very few retired Southern Arizona residents should have Arizona withholding. If your income is so high that you should have Arizona withholding, good job. Super good job. I'll show you some numbers on that too, and you guys will look and go, oh yeah, that's not so bad. Okay, keep our money local. Any other questions, Arizona charitable tax credits?
Yeah, I've got one.
Yes, sir.
We pay dual taxes between California and Arizona.
Uh-huh.
Okay, my prior accountant said that taking the tax credit here would just add on to the California payment, that I really wouldn't come out ahead.
Not quite right. So Arizona and California have a relationship, and California is predominant. So if you file an Arizona and a California tax return, California, on your California return, you get to look at the income that's taxed by California and Arizona, and California is going to go, how much would you pay on this income on the Arizona tax return, hypothetically? And you're going to say, Arizona taxing this income, they're going to charge me $2,000 in taxes. And then California is going to do a formula and say, okay, we're going to give you a credit for $1,900. So we're going to credit you most of what you're going to pay on those Arizona taxes, so that you don't really get a full double. It ends up being like 110% tax. It's not a double. And then when you start to get into that Arizona tax credit to drop it down, that calculation gets a little loopy, but it doesn't change the fact that it makes sense to do the credits rather than pay Arizona. You come out ahead kind of either way. You know, like in the one, I like the money being local. I weigh that higher. If it costs us, if I paid $5 more in taxes, but the Arizona revenue money stayed here instead of going to Maricopa, I'm good with that. Not all the taxpayers are. I know that. That's part of my philosophy. If that's something that really bothers you, I'm sorry. I want to keep the money here. We don't have enough. Look at our roads. Any other questions about this? Good question. Any other questions?
Joe.
Yeah.
What's the logic behind the 987 rather than make it just 1,000? Was it just because, well, we don't want everything?
No, it started at 900 and they're inflation adjusting it up. It was much lower. And they just, every year they do another inflation adjustment and it goes up a little bit. So next year it'll be over 1,000. Yeah, it's just the calculation. All right. QCDs, itemized versus standard deduction. You hate itemizing. Right?
Right, yes.
To itemize, okay, I do this thing with the real estate agents. And I go in, I get a bunch of real estate agents like this, and I go, raise your hand if you love write-offs. Right? And what do? They raise their hand. You go, okay. So it's like, what is a write-off? Explain a write-off to me. Like, my bill is a write-off to the real estate agent. Does the real estate agent want my bill to be higher or lower? He wants my bill to him to be higher. Do you want my bill to be higher? Why does the real estate, like, so if I look at the real estate agent and say, I will charge you $400 for this tax return, but as a favor to you, I'll charge $8. Is there any expense, any write-off the real estate agent has that if they were getting ready to pay it, they're going to go buy business cards, it's $150, they're getting ready to pay, and the vendor goes, hey, sale today, half price. Does the real estate agent go, shit, there goes my write-off? Or do they go, great, that's half price? We don't care about deductions because what we care about is outflow. If we've done the thing, if you sat in the office, I said taxes are about the least important. On top of taxes, we have wealth. And the accumulation of wealth is always a good thing. It's a good thing. If you pay taxes, you accumulate wealth. If you don't have enough income to pay taxes, you're probably not accumulating wealth. On top of wealth is income. We like income. More income is better. I'll show you later. Paying more in taxes is good because your after-tax money is more. That's good. And then on top of that is peace of mind. If we should be able to do what we want to do and be all cool with it. Kind of don't worry about that stuff. It's all gonna. But what we get into is to create an itemized, you have to pay for it. Everybody who owns a house has the same itemized deduction, right? Your property taxes. If you live in southern Arizona, how much do you pay annually on property on the average house? About $2,000, right? Is there anybody here who's going, I pay $10,000? It's not, it would be uncommon, right? Most of these houses, $300,000, $400,000. standard Arizona property tax, these properties, $2,000. Is there anybody who's going, wait a minute, man, you're way off? Because I'll listen. Does that all sound about right? Okay. You're registering your car, $150. You pay sales tax at 6.5% in Green Valley, and they think the government kind of calculates and say about half, 40% of your income you're spending on sales tax items. So we're going to say that's another couple $1,000s a year. Property tax, sales tax, vehicle license tax, maybe you're at $5,000. What you pay in Arizona state taxes, another $1,000. You're at 6, non-discretionary. You don't get to decide those, right? They tell you what you pay in property taxes. They tell you what you have to pay for sales tax. You don't get to decide that. Your standard deduction for single person is about $15,000. So here's the non-discretionary part. It's $5,000. So you would have to discretionary outflow $10,000 to get $1 of benefit. Does the math on that work? It doesn't, right? So what's there? There's your choice. You did your okay, mortgage interest. Cool. Most of my residents, they don't want higher mortgage interest. They own the house outright. So I got no mortgage interest. I got to come up with, married couple, I got to come up with $25,000 to $30,000 of cash outflows for medical and charitable. Do you want a year where you have $25,000 of cash outflows for medical? No. And you clients may remember or may know, if you come into my office and we're talking about things, one of the questions I ask regularly is, are you healthy? Are you basically healthy? Yeah, I'm pretty healthy. Go to the doctor a lot? No, you're not going to itemize. You're not. You got to be donating $15,000, $20,000, $25,000 a year to itemize. If you're not doing that and you're basically healthy, you're not going to itemize. Do you want to? No. No. Now, occasionally, like we have what I call a grill year, right? You got somebody, single person, standard deductions about $15,000. Every year, they get about $5,000 in taxes and stuff. They're not super charitable. They're basically healthy. And then they go and they get entire teeth replacement. And it's $7,000, right? Like big. So then I'm going, all right, I got $7,000 for the teeth. I got about another $6,000 of other taxes. Maybe we're kind of close to itemizing. And then I would go back to that person and be like, well, what else medical can you do this year? Right? Like if you're you buy a hearing aid, you buy a walker, you buy everything you can, you go see every doctor you can, you make 3 property tax payments instead of 2, you register the car for 2 years, and whatever you normally do in charitables, you double it for that year. And maybe you itemize. But that's a lot of work, right? So normally, here's all my medical, you're not going to itemize. Here's all my list of charitables, you're probably not going to itemize. So getting all that stuff together probably doesn't benefit you much. If you summarize it and you don't get to itemize, sometimes Arizona gives you a little credit for non-deductible medical and charitable. But Arizona is like a low tax state. So I'm in there doing the work, like we didn't put the medical in, but they might get an Arizona credit, spend another 4 minutes, put in the work, and they saved $4. All right, they saved $4, they did it, saved the $4, you know, it's there on the screen, you may as well do it. But if you looked at it and said, I spent an hour and a half getting the paperwork together to save that $4, no. Can anybody answer this question I've asked? How much do I value your time at? $200 an hour. I will not give you something to do that will take you an hour unless I think it's going to save you $200. There's a little wiggle in there, but it's in that kind of range. I'm not going to be like, go get me a bunch of medical so we can see if we can save you $10. Because your time is too important to me. I don't want you spending hours going to find me $5. If you're going to go spend an hour, find me a couple $100. Get something out of it. Make it worth your time. Does that make sense? So we don't want to itemize, because if we itemize, we're having to put out all this stuff, pay all this money for medical or something else. If it happens, it happens. It's going to be a bad medical year. That's when you're going to itemize. So hopefully you'll be basically healthy through the year, and then you'll give me a phone call. Go, hey, what's going on? Go, remember how you said I'd never itemize? Yeah. Well, let me tell you a story, because if you're itemizing, right? Like I was on a mountain and I got a helicopter had to take me, like whatever, it's thousands and thousands and thousands of dollars. All right, there's a story associated with it. And you go, but I wasn't tracking all my medical and stuff. Call your doctors, get all the information, and you're going to itemize now. The standard deduction is going up, and there's a good chance that if you're a senior, it's going up by another $4,000 per taxpayer. So the standard deduction for 2026 is likely to be, for a married senior couple, $40,000. That's what you would have to, yes, that's what you would have to outflow in charitable and medical to get a $1 tax benefit. Suck! Itemized deduction, it is the TCJA. It's a pretty good piece of tax code. It had some stuff in there that, you know, as a priest of tax, you're like, what is this? But that standard deduction raising up a lot saved the Internal Revenue Service a lot of time, a lot of labor, a lot fewer audits. It's really good tax saving for the Department of Treasury. So when everything else was exposed and the possible changes in the tax code, if you were here last summer, we talked about that one a lot, that they were pushing really hard. All the think tanks were like, you can't change the standard deduction, it's too good. So they didn't. They bumped it. They like that. What else? Non-cash charitable contributions. Anything $500 or lower, we don't have to prove a thing. So the most common lie on a tax return. Yes, sister. Oh, did you have a question?
I did. You triggered something when you said a little earlier about elective surgeries, elective medical is not covered.
Right.
How, I mean, I suppose, how do they know whether you're elected to have it or not? And then you just said somebody went to get all their teeth done. Wouldn't that be considered an elective procedure?
No, it's doctor recommended. That a doctor's going to say we need to, like the doctor looks at you and says, we advise that you have this done, and this is the kind of thing that Medicare would cover, kind of thing like that. It has a good CPT code. Then it's going to be a covered surgery. They don't want people doing plastic surgery and trying to call it medical. More than anything else is what they're. That's like, it is rare for there to be so like what, homeopathic stuff that's not doctor recommended. Doctors tend not to give you a prescription for a massage. So massages usually aren't. Those are the kind of things that people sort of think of as deductible that aren't generally. Normally, if you would look at it and go, I wish my life had gone otherwise and I wasn't required to do this, it's deductible. Yeah, like if it's bad, then it's more likely to be deductible. No, well, you get into there's some gray areas where some doctor says, well, I think it might be good for you. And I got a guy, he hands me a thing, and it's like, he itemizes, and he gives me the naturopathic, and I'm wondering, you know, like how far of it would survive audit. But it's like $800. And I'm going, if they come and they were thinking about disallowing that, there's a good chance compared to everything else he has that they would go like, we don't even care. If that was the only medical, he's like, here's $25,000, it's all my naturopathic. I don't have a real hard time with that one. That would be a rough one. That would be a rough one. So there's a big difference between donating items and donating money, because the most common lie is on the value of a non-cash charitable contribution. Raise your hand if you've ever shopped at a secondhand store. Raise your hand if you've shopped at a thrift. Okay. Raise your hand if you've ever donated anything to a thrift. Okay. I want to talk about one lamp. We're going to buy this lamp at the thrift store at a good price. What's that lamp worth? What am I paying? 50, but no, right? 5, right? Nobody's paid. I don't care, Tiffany, 15. Okay. When I brought the lamp in and they gave me the little paper, what value did I put on the lamp? Yeah, oh, totally. Yes, like 500, right? One bag men's shoes, $350. You have never shopped at the thrift store. There's no bag of men's shoes that's $350. Most common lie. So what you're regularly going to see on a tax return, we don't care. The government's like, oh man, we're not even going to worry about it. $500 or less. So what we'll see is you guys will be like, 250, 250, 75. And we're like, forget it. I'm just going to put the 500 because I don't have to ask for anything if I put the 500. When you go over 500, we have to go, this is who we gave it to, this is when they bought it, this is what the fair market value was. It's this whole other level of documentation that you have to send in. And it's fairly straightforward, it's not too bad. But what we want you to do is we want you to think about it like that. Like, if I donate my goods, I'm getting $500. And I'm probably not itemizing anyway, so it's not gonna matter. But like, you have those situations where a married couple becomes a single person. And so they've got a lot of stuff in the house that they can get rid of. And it can be thousands of dollars, right? Like I got rid of all his tools and a bunch of the furniture and all his clothes and this other stuff. And then what we can do, what we're allowed to do, is we're allowed to what they call class it. So I can say like, okay, 500 and lower, no questions. 500 to 5,000, I can go, this was all clothing, and this was furniture, and this was kitchen items, and each is its own group that I get up to $5,000. So commonly, our goods that we contribute, the things that we take, we don't really get a tax benefit. But in a year after a passing, we can probably itemize, because if we're donating a bunch of the stuff that the past person left behind, we can get a much higher charitable contribution number. Over 5,000, I have to have it appraised. So, it's 6,000. Really? You got an appraisal? It's 5. Okay, cool. We're gonna put 5. And again, I have never had a non-cash charitable contribution audit. How many of you take pictures of everything? Yeah, right? Like they hand me, and it's on the couch, and it's a picture of everything. The federal government never needs it. Something, we ran the numbers, and something like 98% of the paperwork that we get from you guys and keep, nobody ever looks at again. So, your non-cash again, 500 cheap. And it's very important for us that you differentiate between the cash and the non-cash, because the treatment's a little different. So when you're giving me the information, you don't have to put, I did white elephant $50, this other one $50, $50. Non-cash, $450. I'm gonna put that in the tax return like that. If it's more than that, I need to know where it goes. Any other questions about that? Oh, the IRA thing. Okay. So they have a provision in the tax code where if you have to take an RMD, if you have an IRA and you have to take a required minimum distribution, you are allowed to send a part of your distribution to the charity directly, and then that contribution does not count as income. Okay? So I've got clients that were, and churches count for this one. Churches count for the RMD. This is not an Arizona charity thing. So I have clients that were taking their RMD and it was being taxed, and then they were taking the money out of the bank account from the RMD and going to their church and giving them $1,000. And their charitable contributions were not enough to beat the standard. So they got no tax benefit for the $12,000. You following me? Okay. Then we go, I tell you what, do the exact same thing, but take it directly out of the RMD. Call your IRA people and say, hey, I want you to send $1,000 a month to Desert Lutheran. The IRA sends it directly, and because you never controlled the money, it's not taxable to you. And if a person is in the 12% bracket and they send $12,000, they're going to save $1,400. What did they do different? They did it from the IRA instead of the bank account. Super easy. If you're making charitable contributions and they're not the contributions that get us the Arizona credit, you can't do IRA for Arizona credit. They want that out of the bank account. But if you're making charitable contributions, you have an IRA and it has RMDs, it is advisable to have the RMD go directly to the charity of your choice. Questions on that?
You're saying,
yes.
So it has to be an RMD, though. You have to be at that point.
You have to be at the age that you have an RMD, yeah, and it's capped at 100,000. You can't do more than that. A couple of the little rules, but that's pretty. I was in an 8-hour tax class, and 7 hours of it was, and your $1 million high net worth clients are, listen, they're going to do this and that. Got 3, you know. And then this whole big thing, and then they're going to move this thing to the Bahamas. Like, oh, this is awesome. This whole class on that. And I want to go like, what do you guys do a class for just like people? Just people? So, yeah, I don't have a lot of that. But anyway, so the RMD thing is really good. You want to do it that way. I will reiterate, you only, if you make charitable contributions, and you do get a benefit from it because you itemize, if you make charitable contributions and you get a benefit because you itemize, it is about the worst tax saving you can do. Let's assume you're in the 22% bracket. A married couple can make a couple $100,000 and be in the 22% bracket. So every $100 of charitable contributions saves you how much? $22. What happened to the other 78? It's at the charity, right? We only make charitable contributions if we support the cause. We never make a charitable contribution for tax purposes. It doesn't help. You're saving 22 cents on the dollar. If you're in the highest bracket, you're saving 40 cents on the dollar. Where's the other 60 cents? You don't have it. It's not in your pocket. Thank you, Darlene. Exactly. Good. I hate Darlene. So when we're looking at that, if people go, oh, I want to lower my taxes. I want to lower my taxes. Okay, if you can find a way to lower your taxes without outflowing money, by all means, do it. I can lower your taxes outflowing money in a heartbeat. Make a big charitable contribution. Have a terrible medical year. Buy a bunch of solar. Buy a bunch of windows. Every one of these, bank account value gets lower. Right? Bank account balance gets lower. For all of the, I'm going to outflow some money and get a deduction, your bank account balance gets lower. On the list of things I hate, your bank account balance getting lower, top 10. Right? I don't want my client's bank account balance to get lower. Taxes are taxes, there's things that go. But if you're coming up to me going, I think I want to do this, I want to do that, and the end result is your bank account is lower, generally I'm going to advise no. I want you to have more money, more income, more wealth. Wealth is good. Income is good. Income is good. Anyway, all right. IRA thing, next. Ha! Did I give? Yes. This worked out almost perfectly. Got an hour left. Anybody need a break? Go to the bathroom or anything? Good? Okay. The TCJA. Probably the signature legislation of the first Trump term. There's not a lot of other stuff that they passed that survived, right? So they passed this big change in the tax code. It was good. Something like 65% of taxpayers paid less in taxes once they passed the TCJA. And they did the calculations on it, they predicted some growth, and they realized it was going to blow the budget by something like $10 trillion. So they put a sunset on it. They said we're going to have it for 8 years. And then after 8 years, it's going to give us 8 years to revise the tax code, write a better tax code, make a bunch of this stuff permanent, and then have that new tax code. So we just have 8 years to do it, piece of cake. We're all real smart people, we all get along, we get shit done. Best joke of the day! So they failed. And we knew it was coming, like everybody's like 12/31/25, the TCJA is going to end. And if roughly 65% of taxpayers benefited when they changed to it, roughly 65% of taxpayers don't benefit if we go back to it, right? Go back to paying higher taxes. So there's pretty strong pressure to do it. One of the things that went wrong is they predicted that the growth would offset the deficit gains, and they in no way predicted COVID. So the debt went really high, right? We spent a lot of money. The revenues were good, but they weren't good enough. The growth was good, but it wasn't good enough. And now they want to extend it, and there are some people in the legislatures that are much more concerned about the long-term effect of high debt and the interest rates, so they're pushing back against it. And there's a point, like one of the things that I hear a lot when people talk about budgeting is the cut, right? Like you just cut, that's what you can do at our house, you cut. If you don't have enough money, you cut. If you don't have money, you cut. And where I grew up, if you didn't have enough money, you got a second job. And you increased your revenue, because that's what you could do, because you can't cut past the point where you don't eat, right? There's a point where you can cut, and then you can't cut anymore. Like right now, Medicaid, Social Security, and Defense, right? 3/4 of the budget. They could do everything they wanted to do to get rid of the discretionary part, education, health services, all these other kind of things. I think it comes out to like 1.6 trillion if you just stopped paying for all that stuff. And that's not enough. You have to get rid of everything that's discretionary and then go hit the big three. And there ain't no legislator that's going to look at you guys and say, we're touching Social Security, right? Like, that ain't happening. So the parts that would have to be adjusted, we can't touch. the parts that we can adjust are going to reach a point where if you have the program, it's going to have some money. So you would either have to completely eliminate the program or have it exist at this very low level. And when we do the calculations, it doesn't appear that we can come up with a number where the budget is balanced. Are you with me? Is there anybody out there who's like, Joe, that's ridiculous. I was watching all this stuff and it says the budget's going to balance. Okay, good. So I bet you there's somebody out there, and some people are saying it. They're saying the growth is going to do it. That's the same thing they said last time. It didn't turn out that way. So there's a lot of different competing factors there. And for the most part, I don't care. I care about that standard deduction thing. They're going to keep the standard deduction around at a big number. They talk about not taxing Social Security. They're going to tax Social Security, but they're going to give the elderly the extra $4,000 exemption on top of the standard deduction, which is supposed to offset the Social Security income, right? So that's their idea. They're going to say, well, we're still going to tax Social Security, but with this extra deduction, there's going to be less taxable income. So that's how they're going to offset it. They're not going to actually change the calculation on taxing Social Security. Tips, they don't care. My clients don't get tips. Any of you? I don't deal a lot with overtime. But all that stuff, like when we're looking at it, we're looking at this monstrous preparation load. How am I going to do the return and make sure that I'm properly recording tips and overtime? And the people that look at it say that the burden on the taxpayer, the administrative burden on the taxpayer and the tax preparer, it's probably going to be a couple more hours a year. But if they don't, then the old thing comes back. And the old thing is a little worse. But how much worse? And I do numbers. So we're going to look at that. So here's the first thing. This is the tax foundation. I'm going to use a phrase that some people say is entirely a lie. I don't think it's entirely a lie. I think in this case it's mostly correct with some tint. They are nonpartisan. Nothing's nonpartisan. They're pretty good. Generally, if there's something going on, I check Tax Foundation and Penn Wharton first. They got just really smart people and they know what they're doing. So they took a look at this thing and they said no tax on Social Security for seniors versus $4,000 additional standard deduction. And we've got this really great, were you coming up to see closer? Oh, okay. Standing ovation! Oh. Okay, so there's two things on this one that I think, there's the part that's the table, and then I want to go down into something that's going to be even better. But this is basically looking at the market income percentiles. When we talk about things with tax code, what they do is they take all the filers or the households, and they take the income from 0 to the top, and they bust it up into 5 portions. Top 20%, 60 to 80, 40 to 60, 20 to 40, bottom 20%. And they do it by the tax returns. They do the number of tax returns. So the top 20% of the tax returns filed had this income, and then it goes down like that. So they're looking at the quartiles, and they're going, so our 0 to 2, this is our very low income people, 20% of the returns, tax, no change, because they don't pay any taxes. But as it goes up, you're seeing the effect. No tax on Social Security benefits has a much better effect, has a lower effect for my clients in the first 3 percentiles, but once we get up to the higher percentiles, it benefits, no tax on Social Security benefits is better than the increased deduction, right? This is the 4,000, and this is no tax on Social Security. So you can see on the 4,000 that my clients that are in the 60th and lower are benefiting from the 4,000. Once we get past that, it's 9. And the 60th is the bottom dollar value on the 60. No, the top dollar value on the 60, $73,905. $73,905, 60% of the tax returns have that income or less. Is that most of you? Yes, it is. Yes, it is. So for most Southern Arizona taxpayers, the $4,000 is better. Because most Southern Arizona taxpayers are in the 60 and lower. Check this out, 20%, $17,000. 20% of the filed tax returns, if you took 20% by number, if they got 1 million tax returns, 200,000 tax returns, they went from 0 to the highest income on that. If they started from 0 and went up, the 200,000th tax return would have an income of $17,735. I'm going to ask you an informed opinion. What is an amount in America that you could be poor and still have? Like 17 feels like it, doesn't it? So when people ask, what's poor? It's that, generally, right? Next bracket, 38,000. This is the average income for a single person in America. $38,000. That's a little high, actually, for a single person in America. That's the 40 bracket. 40% of the tax filers, 38,572 or less. Did you know that? Yeah. What's rich? %% bracket, 188. This is the bottom, or this is the, at 90 and 28, top 10% in the country. What dollar value does the top 10% in the country start at? 188. Did you know that's rich? I'm gonna say it again. Did you know that's rich? I got people that make 250 and they don't think they're rich. 95, 266, 99, 611. How much room is in that 99 bracket? If 611 is where it starts, where does it end? Elon. Right? Like that, right? That's all of those people from 611. From here up, this 10% pays 90% of the federal income taxes. The top 10% of earners, it's actually like 93, pays 90%. All of this, from that 130,000 and stuff down, pays about 7% of the total income tax paid by individuals. Crazy, right? What's rich? So here's how I define rich. I got 2 ways that I check. My daughter, if she has a $10 difference in her bank account, she notices that day. She kind of lives on the edge. She's like, I'm trying to send money to her. So she can be like, oh, I went and check my bank and there's a $9 mistake. If there's a $9 mistake in my bank account, okay, I am gonna find it because I'm like that. My wife won't. My wife won't, because she would look and go, we have a balance of this, and she can't tell the difference. How big of a mistake could the bank make where if you were just looking at your balance, you would notice? The lady calls me up, big problem, I never got my refund. We take a look, $18,000 refund. It's like, okay, never got it. It's supposed to direct deposit into the bank. Never got it, okay, cool. So we're gonna check, I'll call California, we'll see what's going on. I call California says, we deposited at this bank account on this day. Call lady up, they said they put it in the bank account on this day. I said, I'll take a look. I said, oh, sure enough, it did. You got an $18,000 deposit, you didn't notice? Rich! That person's rich, right? Like, I would notice. There's a thing, right? Like, how much of a mistake could you make if you go, you know, I think $1,000 could flow from my bank account and I might not even notice. You're probably doing okay. If you take your net worth and you used it to buy the average house in your neighborhood, if you take your net worth and you used it to buy the average house in your neighborhood, how many can you buy? What's the average house in Green Valley? Yeah, that's good, right? 350, 400? I'm gonna do 400 because the math is easier. So if you have a net worth of $1.2 million, you can take all your money, turn it into cash, walk up to a real estate agent and say, I want to buy 3 houses right now. That's kind of rich, right? Now, in San Francisco, that doesn't even buy you a house, right? In Kansas, that buys you a big house. So rich is geographically relevant, right? Like here's rich and there isn't rich. Here's rich and there isn't rich. But if you kind of want to judge it and go, how am I doing? Like if I have to judge whether I'm rich or not, how am I doing? Take a look at your net worth, and if you say, man, I could buy a couple houses with this, you're probably doing pretty good. you know this thing? Less than 50% of Americans have $1,000 that they can reach if they need if there's an emergency. 49% or less of Americans can come up with $1,000 if there's an emergency. How much better than that are you doing? Are you doing better than that? I've got $50,000 in my money market, just in case. What's gonna happen? So that this part here, though, this is what really, when I called this up, I was just so flabbergasted by that part, by those income levels, right? 20,000 or less. More than half the country, 74,000 or less. You know what you make. You've got your own tax return. How you doing? Take a look. That's what matters, that income number. Okay. So they're playing around with that. That's fun stuff. And then we're looking at this thing. Okay. So these guys gave me this awesome tool. We're going to go to the handouts now. And the first one we want to look at what am I looking at? Let's see. Oh, I'm going to hit this one real quick. The small estate affidavit. Small estate affidavit. Has anybody been in my office and had the I hate trust speech? Have you been in my office and had the I hate trust speech? Okay. I'm telling you, trusts suck. What you're looking for is fastest transfer of assets from the deceased to the beneficiaries. I die, they get it, right? Generally, okay. And least amount of paperwork. So if I say paperwork, you say
No.
probate. I say paperwork, you say probate. Paperwork? Probate. Paperwork? Probate. Standard probate's 13 forms. In Arizona, if you pass away and the assets that are being resolved in your will have a value of $75,000 or less, you are entitled to use the small estate transfer. And the way this works, our formula here is, okay, so as sort of a foundational, this works when the asset, when it's simple. I die, they get it. I die, they get it. If it's I die, they get it on a schedule. I die, we have to kind of figure something out. All that kind of stuff, this plan doesn't work. But for 99% of my clients that have the I die, they get it plan, this is how we're doing it. Take a note, do some homework, call the family, talk to your person or whatever after this. This could be incredibly helpful. This does not avoid probate. But the probate is one 3-page form. So, first thing you do, designated beneficiaries. On every asset that you can transfer, you designate a beneficiary. So you go to your Charles Schwab, Merrill Lynch, RBC, whoever, and you confirm that your beneficiaries, your heirs, are the people that are supposed to get it when you die, not the trust. The heirs. And 2 people in the audience right now are going, I hear what he's saying, but it's going to the trust. I know what he's saying, but it's just going to go to the trust and that's going to be fine. It's not. The trust makes it worse. Trust stands in the way of this working. So bank, brokerage, anybody who's got your stocks or anything, you go to them and you say, I want to make sure when you find out that I'm dead, that you're going to send my money to these people. Okay? Bank, brokerage. Any transferable retirement. IRA, pension that somebody gets or something, same thing. Not to the trust, but to the people or person that you want to get it in the end. Your real estate. You file a transfer on death form in Pima County that says, if you find out I'm dead, I want you to change the ownership of this house to this person or these people. Questions so far? Yes?
If you have property in California.
California has the same provision.
Okay.
California has the same provision. For designated beneficiaries. Yes, sir?
If you have your beneficiaries and they get all the money, you still have to go to probate if that's all you got?
No, well, we're going to get to that.
Okay.
Okay. And yes, but you don't care. Because it's a real easy probate. It's a real easy that's the thing is people go, I don't want to go to probate. And I go, what if probate was a 2-page form and you signed it and sent it in and that was it? That doesn't sound so bad. Yes, ma'am.
How does, using first-terpies in your trust or your beneficiary designation affect this? Because I've been told by Vanguard, Rice, that you can't use first-terpies.
Like as a designated beneficiary? Yeah.
You have to designate, let's say, your children.
Yeah.
You can't put
Past it.
first-terpies in.
Correct.
To get it to your grandchildren.
Correct.
In that family.
In a per stirpes way, you could say the grandchild is just the beneficiary. You're trying to do it, you're saying the grandchild's the beneficiary if the parent, if my child has passed away, and usually they don't have that provision. You're right, that will stand in the way. Does everybody understand what she was asking?
No.
Okay, so what she's got is a situation where she wants to go, when I die, my money goes to my kid. But if my kid's gone, whatever.
Yeah.
They're elephants, I don't know. So money's gonna go, but if that person is deceased, I want it to go to their heirs. And the term for that, per stirpes. So that's basically where you're saying, it goes to this person, and if that person is dead, then it goes to the next person in the line. And the designated beneficiary thing doesn't do that because it won't trigger it down. You would have to be there and go, I had my son on here, and he is now dead. So I'm gonna go change my beneficiaries to his kids. Does that make sense?
Yeah.
That's how you would do it. Yeah, a little bit of work. Okay. But, we take some time on it. It's not the kind of thing that you have to do in 5 minutes, right? Like you can really kind of stew on it. Okay. So in our situation, we've gone to bank brokerage. We've told them, look, when I die, my money goes to Huey, Dewey, and Louie, equal proportions. We went to our IRA and said, Huey, Dewey, and Louie are taken care of. So in this case, we're taking care of Lydia and Maybelline. They each get half of it. And I've got the house. The house is going to Friends of Deed. And it's all documented somewhere, right? We filed with Pima County, a transfer on death. We went to the organizations that held our money, and we told them what to do. And you die on Wednesday. So, and you've got nobody in town, so I take care of it. I know already what's coming and everything, and we've got it already, we know what to do. You die on Wednesday. We call Green Valley Mortuary, they get your body. Monday, hopefully, they call me up and they say, I've got the ashes and the death cert. Are you with me so far? Okay. I have the death cert. I have proof that this person has passed away. I present this death certificate to the people that hold my deceased person's assets. I go to the bank and say, I'm letting you know Dave is dead. And the bank looks and they go, Dave is dead? Oh, when Dave was alive, he told us a thing. When I die, give this money to my kids. Hey, thank you, Joe. We're going to do our job now. We're going to split this money up and send these kids a notice. I go to Charles Schwab. I send it to them. They go, great. We're going to do our job. I go to Pima County. I show it to them. They go, great. We're going to do our job. All of them will do the directive that our person gave them when they were alive. They have a directive in their paperwork that says they have to do a thing. Okay? So Monday, I get the death cert. Close of business Monday, I've told everybody. Bank, brokerage, I emailed some things, I faxed some things, but everybody that has my client's transferable wealth has been notified that the client is dead on Monday. 48 hours later, Charles Schwab has taken the account, busted it up, sent an indication to the beneficiaries. 48 hours later, the bank has taken the account, busted it up, sent a letter to the beneficiaries. 48 hours later, the IRA is successfully transferred to the beneficiaries. Week later, beneficiaries get a letter say, you've got an account at Merrill Lynch. You own a portion of an IRA. Week later, Friends Indeed gets a title to the property or whoever the beneficiary was on the house. Right? I spent a half a day showing people that you're dead. And they did their job. And they give all that, they take all that money, right? So you died on a Wednesday. Following Monday, we went to the people. That following Friday, your beneficiaries own their assets. They own your wealth. They've got the money, they can do with it whatever they're gonna do. Maybe, Charles Schwab is like, hey, we need a little information. But all of those organizations do their stuff, right? Nobody is going in there saying, I need you to transfer this account, I need you to do all this. Those places do what they're supposed to do, what you told them to do when you were alive. With me so far? Okay. So, died on Wednesday, following Monday, told people, following Friday, Beneficiaries are good. Beneficiaries are getting their money. I wait 30 days. Wait 30 days. Is there anybody coming up knocking on the door saying we owe them for something? Pay all the final bills, cell phone bill, pay that final credit card, pay La Posada for the last time. All that's done. All that money's done. My 30 days pass. In that thing, the small estate affidavit, this packet right here, you go a couple pages in, and you're going to see the affidavit of collection of personal property. This 3-page form is the probate. It asks very complicated questions. Name of person who died. My relationship to the person. Here's where you guys get messed up. Value of personal property. The value of all the personal property in the deceased person's estate, wherever located, minus loans and encumbrances, is not greater than $75,000. Everything that went out by designated beneficiary doesn't count. None of that is in your estate. If I get rid of bank, brokerage, IRA in the house, what do you got left? Furniture. Is there any way that I'm selling furniture, kitchen, clothing, and bathroom for $75,000? Not. I mean, maybe. I have a Chippendale, right? That kind of thing, right? That kind of thing. Outside of that, most Southern Arizona residents are going to be able to take advantage of designated beneficiaries, and when they pass, their heirs are going to promptly get their wealth. There's no tax on a wealth transfer at death unless you had died with more than, who knows the number? How much? No, go, someone back there, what was it? $14 million. And I tell the lady, she goes, oh, your kids aren't going to have to worry about it unless you die with $14 million. And she goes, good. I'm like, no, your kids want you to have a taxable estate. They'd be really fine if you died with $14 million. Work on it. So at that point, we've distributed the assets. Now I'm at the will. And when I'm deciding what's going out in the will, it's the contents that the estate sale stuff does, right? It's the clothing and the things like that. And it's going to be under $75,000. I fill out that form, it's done. So the assets transfer fast, there's no tax implication, and the administrative time is a couple hours. Are you with me? Right? Did we do a probate? Yes, we did. 3-page form. Piece of cake. The great thing about this, all of you get to go and talk to your other people and stuff and say, hey, I heard about this thing that I can set up these designated beneficiaries and do this thing, and I don't even need my trust anymore. This is going to cover all of that. It's going to take care of what I need to. And I think everybody that you talk to, when you talk to your people at Charles Schwab or whatever, they're all going to go, yeah, that's the way to go. This is a really good thing. We use a trust when the assets coming in are complicated. I own a farm. What's the value on the farm? Different yesterday versus today. That's complicated assets. I use a trust when the assets going out are complicated. Dave gets $1,000 when he turns 18. He gets $10,000 a year until he turns 25. From 25 to 35, he gets $20,000 a year. If he ever has a medical emergency, he can extract more. If he gets married, he can take out another $50,000. Okay, that's complicated. I have a trust because there's a time period there and there's triggers. But if your goal, die, they get it. Look into this designated beneficiary thing in the small estate. If you have any questions about it, let us know. If you Google it, you're going to see a bunch of lawyers that are going to give you another standing ovation. Thank you. You're going to see a bunch of lawyers that are like, yeah, this small estate thing is really cool, but boy, you might want to have a trust. What does a trust cost? Yeah, I think the cheap ones are $1,800. What do they do?
If you already have a trust, would you cancel it too?
Immediately. Oh, this is a good one. The question is, how do you cancel the trust? Where did you file it? Oh, and what city, state, county did you file it in? Did you hear her answer? You don't. You don't. So who knows that the trust exists? But and even them, they don't. Typically, your trust is sitting in a 3-ring binder on a shelf somewhere. If you take that 3-ring binder and you look in one of the last 3 or 4 tabs, there's going to be a 1-paragraph revocation. And it says, I, your name, do hereby revoke the trust as of this date and sign it. But you don't send that anywhere. There's nobody out there. So a trust is a legal document that, like if you called the kids and said, I've killed the trust, it doesn't exist anymore. None of the assets are in the trust. No assets are going into the trust. When I die, designated beneficiaries are going to send you guys the money, so the trust doesn't need to exist. You could keep the paperwork forever. It'll never matter, because the trust will never own an asset. Does that make sense? That's where we mess up, is we put our assets in the trust. A trust is an entity that exists. We put stuff in a trust like I have so much money. I have more than 15 million. And when I die, things trigger. And trusts don't die. So if I put it in the trust, it can live forever. And it never has to worry about death, taxes, and things. Yes, ma'am?
But you have to redo your beneficiaries.
On,
If you have it in the trust, the beneficiaries are usually listed in your trust.
yes?
So you have to redo them.
When you say redo,
Get rid of the trust, you have to put in the persons you want to put in.
no.
No?
No, so we're going back. So hypothetically, let's pretend that I'm a trust, I've done it the trust way. So if you go look at my Charles Schwab account, the designated beneficiary on my Charles Schwab account is the Joseph Lessard Trust,
Right.
hypothetically. Okay, so when I die, what's gonna happen is my assets in there, my executor is gonna go and say, he died, so I have to go make this trust for real. I gotta go get a tax ID number and all this, because it's gonna own assets. So I die, my assets transfer into the trust. Why? So my assets transfer into the trust. How quickly do I want to take the assets out of the trust and give them to the beneficiaries? How fast? What's the best we could do? Instantly, right? Yeah. So I've got the trust standing there going, wait, not yet. I got to do my little part first. And you're going to get the stuff afterwards. And the trust stands in the way of the beneficiaries getting. Now, if I'm the executor, the day I have the trust in, thank you very much. Have a great day. The day I have the trust in place, I'm sending the money out. Like the trust holds the assets for 2 days. Because as soon as I can, I'm liquidating those, I'm sending them to the beneficiaries, I'm holding back just enough money to do the tax return. And if I'm doing the best job I can, I'm doing that the day the trust gets the assets. Like that day. If not, by the end of that week, the trust does not benefit from holding on to the funds. I'm supposed to give them to the beneficiaries. This trust was created. Why do we make a trust? What are the two things we create a trust for? Probate and taxes. No taxes, because we don't die with 14 million. It's a 3-page probate. So what's the trust do? Nothing. Yes, sir.
How do you handle international without the trust?
Well, it's the same kind of thing. Like can you get into some stuff because what is it? Germany has this completely different inheritance tax and stuff. Okay, real big deal. But there you're talking about complications in the outflow. All right, maybe I set up a trust if I have complications in the outflow. So, raise of hands, international beneficiary. 1, cool. Okay, cool. See, so yeah, here's trust, right? But most cases, what we want, I want to die and they get it. I want to die and they get it. In the state of Arizona today, more than 100 people will die. Do you think they all have a trust? No, most don't. Why do you have a trust? Good lawyer. Hell of a salesman. And then you get this thing and they tell you, one of the things, I'll get you in just a second. One of the things I hate is when my clients make decisions out of fear. I think fear and greed lead to bad decisions. More than anything else, fear and greed lead to bad decisions. So I don't want you making bad decisions out of fear. I think one of the causes of fear is misinformation, that you don't know. And as a result, you don't know, and then you make a decision and you're not sure. So if it's at all possible, if I can be a resource that helps you get the information so that you're making the most informed decision you possibly can, let's do that. And then if you're in this room, odds are you do not have a long history of being stupid. You don't. You've probably made fairly good decisions most of your life. You're going to look back on the 5 or 6 dumb things that you did. Oh, that one time. Okay, you want the dumb one? None of you bought a Bitcoin. Right? You gonna tell me you didn't have $10,000 in 2014 that you could have put into a Bitcoin? I bet you 50% of the people in this room had $10,000. I bet you there's 5 people in this room that in 2014 didn't want to sell stock because they didn't want to pay the capital gains, would have had $50,000, could have bought 10 Bitcoins, they'd have $5 million right now. That's a couple of you. We don't always do what's smart. That's the way it is. So within this certain frame of stuff, we're going to say, okay, we're going to try to make it as right as we can. You had a question.
Yes, the stocks that are in, say, Schwab,
Uh-huh.
do they send cash, they sell those stocks?
No. They transfer the security and its value.
Transfer the
Yep.
value.
Yeah. Just like that. Dear Lydia, your father passed away. We have opened a Charles Schwab account. Go to the website, sign in, do all this, and it's all yours.
Right. If there's two people that it's going to.
Uh-huh.
All right, how do they determine which stocks go to who, or is that something that you have to do?
No, they split the assets. You have one stock, they got half, they got half. So they would just split everything down the middle. Yeah, unless you did it, and if you could, I mean, if you wanted to complicate it like that, you could. But generally what you're gonna do in that case is you're gonna create an extra account, and this one's gonna go to that beneficiary, this one's gonna go to that beneficiary, and you split it like that. I got a lady, her beneficiary list changes. It's a couple of people and a few charities. She's got it typed up. So when she changes it, she just takes it to her people. She says, here's my new beneficiary list. Charles Schwab puts it in their records. And they know when she dies, this is what we do. You first, and then, yeah.
The reason I went into trust was because of how,
Sure.
I mean, that's a big thing that is going to be complicated until my trustee keeps some of the money instead of distributing it, because you're going to be hanging out of the house for a year and you're going to be paying.
That kind of thing.
And that's my concern when you say, give the house away. That's one of the best things I can give to the kids.
This is the house.
Yeah.
Yeah, give it to him now. How much can you gift a year tax-free?
All six of them?
How much, sure. How much can you gift a year tax-free?
I'm sorry?
How much can you give away as a gift a year tax-free? Everything. You guys know 15,000, right? That's 15,000. 15,000 is a filing number. If you give away more, and it's 19, if you give somebody more than $19,000 in gifts in the 2025 calendar year, you have to fill out a form. It's 709. It says, hey, government, I gave this person money. Guess how much tax you pay? None. There is no tax on a wealth transfer until your wealth exceeds 14 million.
How would you give a house to 6 people?
You would title it.
All 6 of them?
Yeah.
Yeah, it could be a seat.
Yeah, just like that. They each own 1/6 equally. There's no difference between a house and a commercial property. And you can imagine 6 people owning an apartment complex. House is the same thing. Just a piece of real estate. Just a piece of real estate with some sort of form. Anyway, I jumped off to that. Okay, did I kill all this time? So, we're gonna go to these things real quick. I wanna find, you should have one that's a married couple with 68K. Should say 68K kind of circled on it, just like that. Let me see if I can put one on the screen here. Put one on the screen here. Thank you very much. Have a great day. How are we doing on time? Oh, I messed it up. We're gonna go. 68K. 68K. I got a couple, well, you might not have got both. I'll get one on screen now. I'll show you a couple things. This is, just I'm going to bounce around. This is the Tax Foundation's little scenario website thing where they're looking at the current tax code versus the other tax code. I'm going to just hit this one because this is mostly you guys. This is James and Eddie, retired married couple, $48,000. If the TCJA expires, their taxes would go up $340. So it goes up. But this 340, you're supposed to see that and be like really, really mad. Because their tax went up. Their tax went from 48 to 52. Do you think they even notice that? No, you guys don't notice that. So when they talk about 63% of taxpayers are going to have the tax go up, that's kind of what they're talking about. If it goes up $1, that's what counts. And most of our taxpayers, it's not going up like double. It's going up like that, right? Like what percentage of the total tax is that? That's less than 10% of the total tax. So it's going to go up a percentage point or two. You don't have to be super afraid of it. Okay, so I'm going to find that thing here. And And we're gonna find the one 68. Okay. All right. So this is my married couple. This is my retired married couple. They make $68K in income. They get $50,000. They each get $25,000 from Social Security, $1,000 of interest, $2,000 of dividends, $5,000 from an IRA, $10,000 from a pension. Their income is $68,000. Okay, now some of that goes out for insurance and other crud like that, but like dollars, $68,000 is what that's supposed to be. That's about average. Married couple in Southern Arizona. It's about the average. So if we go down to the next page, what we're going to see is our federal income tax summary. And what you can see that at that level, $50,000 from Social Security and all that other income, you have a tax of 0. Standard deduction. We threw some stuff in there to see if we could get it up. We gave them a bunch of medical. We paid some taxes. They paid some interest. They did $2,000 of charitable contributions. They outflowed $26,000. Didn't get a tax benefit for it because they're standard deduction. We learned that one, right? And then we come down, they finished with a net income of a negative $1,750, no tax. And then we'll go look at the next page for the Arizona, and you're going to see that it's the same thing, but it's still zeros. Okay? So, married couple, income around $68,000, Southern Arizona, no tax liability. If they kill the TCJA, about $500. They're probably not going to do it, but that person's tax is probably going to go up about $500. Good? With me so far? Next, $86,000. All right, so my married couple in this case, thank you folks very, very much. We appreciate it. $86,000. I doubled the interest, the dividends, the pensions, kept the Social Security the same, bumped up a little more capital gains. Federal tax, $3,097. Arizona tax, $200. After tax income, $82,000. Got in about 86, paid a couple thousand taxes. Did they pay more in taxes than the first example? Yes, by $3,000. Which after-tax amount would you rather have? This one. So you want to pay more? Yeah. Yes, I do. Yes, I do. This person paid $3,000 more. How much? $3,000. Oh my God. Okay. So let's get silly with it. $124,000. We got the same Social Security, bumped the pension to 40, the IRA to 20, $14,000 from the investments, $20,000 of cap gain. Taxes on this, $10,000 federal, $2,000 state. Walking away with more than $100 afterwards. How's that feel? Which one's better? The one where you pay more in taxes? Is this what we've learned our whole life? No. If taxes relate to income, it's a good thing. Now I'm going to do this little part because you guys don't know this, and I want to show you. This is one of the most common myths. Most common myth number one, the gift thing. That you pay taxes if there's a gift. There's no tax on a gift. If you're in the total that you gift in your life is over the $14 million, then conceivably your estate pays a tax when you die, but your gift recipients never pay a tax. Okay? And that number that we talk about, the 19,000, it goes up every couple years, that's just the number where they expect you to file a form. So if you got somebody out there that could really benefit from your money and you've got the money to give them, and especially if it's someone who's going to be getting the money within the next 20 years anyway, talk to your people about gifting it now. Yes, sir?
So they don't pay the taxes on it. If it's part of your, so say you made $120,000 and you gifted $20,000, does that come off my tax? In
No.
other words, like
You would have,
still
so,
my income?
so hypothetically, you win $120,000 at the casino.
Okay.
You're paying taxes on that income.
Right.
At that point, that income has been taxed.
Okay.
What you do with it is wealth transfer.
Okay.
The top of the form, this is part of it where it gets messed up. Like, read the form. She's gonna come kick me out. U.S. income tax return. Income.
Right.
Like work and investment and selling things, not just money showing up from your parents. That's not income. Income is all this other stuff, wages and interest and dividends and stuff. That is just wealth transfer. That's not income. So people mess that up. They think of it as income. Okay, so I'm showing you these people that are 124,000, and I'm going to go to the worksheet for them because this is the second most. Okay. For a married couple, the 10% bracket is from $0 to $23,200. Do you see me up there? Okay, that's the 10% bracket. The 12% bracket, 23,201 to 94,300. Do you see how I have two numbers over here? The money in a bracket never leaves the bracket. So when you go to 20%, your 10 stays 10, and your 12 stays 12. It doesn't all go to 20. Oh, yeah. There should be another one. It's a one-page, it's a worksheet, and it should say something like, okay, so this is a person with $1 million. Okay? They're in the 37% bracket. Everybody see me? Okay. So their 10% bracket income was taxed at 10, will only be taxed at 10, will never be taxed at an amount higher than 10. Once they've done all the 10, they have some income that's taxed at 12. Only taxed at 12, never taxed at 12. After that, 22. After that, 24. After that. So if you go into the 37 bracket, in this case, only that $341,000 is taxed at 37%. Do you not want to go into a higher bracket? Or do you? Yes, you do. You go $1 into a higher bracket. That's the only dollar that's taxed at that higher rate. So people will say, again, second most common myth, oh, I don't want to go up to another bracket. Bullshit, you want the income. You do. And if you think that wanting to go into another bracket is crazy, are you aware of anyone who's incredibly rich? They're in a higher bracket than you. They got there by choice. Right? Elon does not have to be one of the richest men in the world. He chose all of those brackets. He's looking going, shit, I'm going to be in the 37% bracket. I better make $1 billion this year. Right? So as you're thinking about that thing with the bracketing, don't worry about the bracket. There's a little bit, like we do some stuff, I'll have people, has anyone given thought to converting IRA RMDs to a Roth? Yes, sir. Oh, you, okay. So one of these things that we do when people say, I got this IRA, I got to take these RMDs, I don't really need it, I got a kid out there that's got a ton of money, so when they die, they're going to get my IRA, and they're just going to tax the crud out of it. I'm in 22, my kid's in 34. So when they get the money, they're just going to tax the crud out of it. So I'm just going to start putting it into a Roth. Say, okay, what bracket are you in? I'm in the 22 bracket. What's your total income? It's about $130,000. Okay, well the 22 bracket goes up to $200,000. So you could take out another $75,000 or whatever, and it's going to be taxed at the same 22% that the other money was. And you could take out more. You could take out, like hypothetically, if your income was $100,000 and you wanted to exhaust your IRA, and you didn't care that you went from 22% to 24%, because it's a 2% bump, it's not that bad. Then you go, all right, I'm going to take out until my income is $380,000. And you'd have that chunk at 24 and that chunk at 22, and you'd go over and put it into your Roth IRA. You'd be paying pretty much the same tax you'd be paying on the IRA money whenever you take it out, because it's always that like 22 bracket money, right? Does that make sense now that we know how the brackets work? So what is the difference between the first dollar you own in the 22 bracket and the tax you pay on it, and the last dollar you own in the 22 bracket and the tax you pay on it? Nothing. So then if I'm looking at it, you go, oh, well, man, if you do that, if I exhaust that bracket, my tax is going to go up. Yes, in dollars, but not in rate. And if we could have that money, I'm gonna go back, I'm gonna keep going back. NVIDIA was $90 3 weeks ago. It's 135 today?
36.
If there was a person who was wise enough and was looking at it and going, I can bring some extra money into my thing, it's gonna be taxed at pretty much the same rate as all my other money is, and I can go out and buy NVIDIA today, that person would have made 35% in a month, right? So as you're looking at that and you're seeing where you're at in the bracket, kind of have an idea of how much more room you have. Yes, you would pay a higher tax, but not a higher tax rate, right? And then maybe you're taking some money that you're bringing in and you're doing other stuff with. And you go like, it's like, I love this complaint. And have anybody ever think like we're going back in time? Have I done anybody in the audience here who's done the, we're gonna go back in time and talk to you? One of my favorite things to do is to do this little thing where my client comes in and they go, I have this problem. I go, what's the problem? I have to start taking my RMDs. So, okay, so let's do a thing. We're gonna go back in time and find 25-year-old you. And we're gonna talk to 25-year-old you. We're gonna tell them about this problem. We're gonna go, look, 25-year-old you. 73-year-old you is pissed off because they have too much retirement money. They're angry about it. They have to. Like the government is looking at them going, you have to take this much. And they're going, damn it. 25-year-old you, how do you feel about that? 25-year-old you's like, I got no problem. That's totally fine. But then we reach this age. So if you're looking at it, you're saying, I got this RMD, I'm gonna be paying taxes on it anyway. Maybe within it, we can look at it and say, how much of that money can you put in hand and what can you do with it? For example, how much of it can you gift? All of it. How much of it could you send to a charity? Up to $100,000 a year. But like that, right? And you're going, oh, I'm in this guy. So when you're looking at your brackets and what you're thinking of, realize that like most of my clients, 12, 22, 24. I got a couple that are out there in the 32, a couple in the 37. But most of my clients, 12, 22, 34. That's probably you, right? And remember when we were looking at that chart that was saying 17,000 is the bottom 20%, 40,000 is that next chunk? Where is that in these? What percentage of Americans are in the 22 bracket? Very few. Compared, right? It's almost all 12. When we were looking at that chart that we were seeing, it was $80,000 was the top of the 60th percentile, right? So very few people are into the 22. Once you're in the 22, you've probably got a lot of room. And if there were things that you wanted to do, create a little income, move some money around, take a little something out, you've probably got a lot of room to do it. Don't let the thought of a bracket stop you from doing something really good. If you're gonna do something with your money, who's probably getting it? Yeah, someone down the tree, right? Somebody else out there, okay. So the analogy I have is 2 rooms. And in this room, I've got the guy, and he's got a net worth of $3 million. He's got 4 people that are gonna get it. And as he understands it, they get it when he dies. And he's been hanging on to it. He's had a couple million for a few years, and it's been growing a little bit. He invests like a 95-year-old. He ain't buying no Bitcoin, he ain't buying no NVIDIA. His market, his account's grown 7-8% a year, real steady, real solid. And he's been sitting on it, kids know. He's laying there, last day. She had 5 million 7 years ago. Now, she's got about 250. That 5 million to 250, she just gifted that out. She called the kids, she said, hey, I'm gonna die, you're gonna get this money anyway. What debt do you have? Go, we got a car payment, I'm paying it off. We still owe $100,000 in mortgage, I'm paying it off. What money you're supposed to, this is all the money you guys are gonna get. And I'm telling you, I don't care about fair, because if it was fair, I would spend it. Right? Because I earned it. So if it was fair, I would spend it. Do you know who Shaquille O'Neal is? Yes. Shaquille O'Neal looked at his kids. Do you know if Shaquille O'Neal, does he work right now? Yes. He has a TV show, right? Goes up to his TV. Shaquille O'Neal is richer than everybody in this room. And he has a job. Shaquille O'Neal looked at his kids. He said, you guys, you're not wealthy. I'm wealthy. I'm wealthy. I worked for everything I've got. You are not. Now, if you had something in mind, well, come to me about it. Hey, Dad, I want to open up a little shop. I want to do a thing. I want to do that. You come up to me, I'm probably going to listen. And I'm probably going to help you out. But none of that money is yours. That's my money. And I want you all to have that same attitude. And if you can, and I don't want to cause any kind of fight, but this is the way I look at it. I go to the kids and I say, hey, look, I got money, and nobody gave me a dime, and life wasn't fair to me. If there's anybody in here who goes, no, life was really fair to me, go ahead, you're cool. But most of us, right? Nobody earned it for me, I earned it. The only reason I have it is because I didn't spend it. I could have been much nicer to me. I could have ate steak, and I didn't. So here I am, and I got a bunch of money, and you're probably gonna get it. So first off, fair is irrelevant. I don't care who gets what. So if anybody of you are like, well, your sister got something, so you should get something, you're out. You're out, you don't get anything, because I don't need the hassle. It's not your money, it's mine. And I get to do with it whatever I want. If I wish to, I can make a pile, I can put lighter fluid on it, I can light it up, and no one can complain. And if you have a problem, that's what I'll do with your chunk. And look at them and say, look, this is the way it goes. If you think in the end you're not going to benefit, you're wrong. Because I got a lot of money, and you're going to get a chunk. So let's figure it out. What can we do? What debt can we pay off? Let's do that. Do I got anybody who's between the ages of 18 and 25 who's working? Are they putting anything into retirement? Do most 18 to 25-year-olds right now put in? No. I'm going to them and I'm saying, look, if you put $1,000 in an IRA, I'll put 4. You just put $1,000 in an IRA, I'll put 4 into that same IRA. You're going to get a 400% return the minute you invest. And I will do this every year that you let me, as long as you don't take it out. $4,000 a year. Do you even notice $4,000 a year change in your Charles Schwab account? Probably not. Some of us, we're not all. That kind of thing. And then we're taking our wealth and we're transferring it. So she's done that. They went on vacations. She sent a kid to Norway. They did all that. In this room, I got a bunch of people looking at watches. In this room, I got people having conversations about their lives. Look at Grandma, look at what we did. Look at the pictures of the trip we took. Here's the house you helped us buy. What's the room you want to be in? That's your choice, right? I don't know what factors and what forces are going to be sitting out there in the world that are going to try to make you afraid, and they're going to tell you don't do that. I don't like those. I don't like you to make decisions out of fear. So if anything like that is going on and you're thinking about it, let's get a phone call. Come and see me. Bring the kid in. Whatever it takes to get you there. The two things, we're friends. So the two things that you shouldn't have to hassle are death and taxes. It's my job. And to help you out, whatever. Yes, sir.
Sounds like you read the book Die with Zero.
I did. I did.
It's a wonderful book.
It is a wonderful book, and the philosophy absolutely makes sense. But I go back to it. I say, so people get rich quick, get rich quick. Everybody wants to get rich quick. Bullshit. I have 1,200 clients. I don't have 3 that got rich quick. I used to have this one guy, I made the talk about him. I would use him as my example of a guy who got rich quick. He had this thing, he sold it to Dolby, made $10 million. Looks like he made it in a day. And I went to him, I said, yeah, you're my example of get rich quick. And he's like, what? Bachelor's, master's, PhD, 4 failed prototypes. Quick? No. Work hard, sacrifice, save, make the tough decision. Who in here didn't do that? Yeah, that's what I thought. Okay, the sacrificer gets the money. Simple rule. The sacrificer gets the money. Because it looks like this. Why are you rich today? Because 40 years ago, instead of McDonald's, bologna. Instead of Disneyland, camping. We had that car for 17 years. We had that couch for 20 years. We had that mattress for 20 years. I still have the same plates we got in our first house. I wore shoes for 7 years. Right? I have a belt that I've had since I was 30. It don't fit no more. It's hanging. It's aspirational. It's aspirational. Don't be nice.
The sacrificer. So when I look at, we talk about philosophically, the unsacrifice. I want you today, if you can, you go to Ragazzi and you have the Italian dinner you didn't have on June 10th of 1963. Are you with me? Are you with me? Yeah. There's a rule amongst the financial guys, money finds an asshole. So this guy, he's got that one kid that's like, yes, the dad of the family estate, we're gonna do this thing. So this guy dies with $2 million and the kid gets it. He's 95, so the kid's 70. Doesn't need it, life is all good. He gets the family estate, does the same thing as his dad did. I'm gonna take this money, I'm gonna cut it, and my $2 million is gonna be to $4 million, and I'm gonna give it to my son, who's gonna keep investing it. And that son's like, yeah, and he's met the grandfather. He has kissed the grandfather. So the family money, he has touched the person who created the family money. And the grandson saw that. And he's like, yeah, my grandfather was real great about this. And he did this thing. And my dad really cared. And he made this for us. And now we've got this like $8 million that we're never going to touch. This $8 million that's the family money. And he's good. And he dies. And his kid gets it. And he buys a boat. A big boat. Really nice boat. Because he never met grandpa and he doesn't give a damn. Your money will find an asshole. Spend it. Is there anybody that wants to argue with me about that one? Right on. Best example I have was the client that came in a couple of weeks ago. And they said to me, we need to figure out how to do this with more money. We're going to do this cruise. We're going $100 and some odd thousand. You guys, I have been so happy since I heard that. Yes! Yes! Memories are worth more than money. Memories are worth more than money. Love is worth more than money. Time is worth more than money. Do other things. I'm almost done. Is there anything else? Questions?
Great job.
Yes?
We are one of those people that spend a couple of grand and we pop into a trust, which we don't need because I already have all the beneficiaries and everything. So we're gonna do something else. But if we were to call your office, would you have the name of an attorney that has the same mindset as you? Because most of them try to talk you.
No, they don't. They all want you to go to the trust. They all want you to go to the trust. They make $1,800 and then you're going to amend it. They're going to charge you another $2. It's very much in conflict.
So as long as we have
Yeah, and I offer, like, you do not walk out of here and be like, Joe told me this thing, I'm not going to check it, I'm not going to do anything, I'm just going to do exactly what he said instantly. No. You go to your people and you say, hey, we just want to confirm, Charles Schwab person, I want to confirm, I got this thing. As I understand it, these designated beneficiaries are going to take care of this for me. Could you kind of explain how that works? And they should go, yeah, here's what's going to happen. When you die, we're going to get this, we're going to do that. And what you should hear is things that as you hear that, it gives you reassurance and comfort that your heirs are going to get your assets promptly.
We already have that.
Yeah, yes ma'am.
But the house right now is currently vested in the trust, that's what the deed is, so we have to take it out of the trust and put it joint tenancy?
Yeah, or just, yeah, joint
But
tenancy.
we still have the situation if upon one of our deaths, then it has to be, or both of our deaths, still has to be dispersed to the kids.
Right, the transfer deed will have both your names on it.
Right, but still, when one of us, when both of us pass away, then we still have to deed it out to the kids, and we've got a full succession plan.
Yeah.
That won't happen.
I think it will. I think it still will, yeah. Yeah, there'll be some stuff, like I said, some subtle, we can look at it. Her first, yes. Taxes, correct. That is correct. Once your wealth gets over, if anybody's looking for a friend, I think somebody in the room might have a taxable estate. No? Sorry. Yes, ma'am.
You didn't talk about the fact that somebody dies, whether it's in the trust or probate, you have to take the death certificate that comes to the account. That takes the
Mortuary does it.
Yeah, they'll get it.
Yeah.
And we have to pay the debt of the person who died.
Well, if we can handle it,
Are not available in the
right, if we can handle it, then most of the stuff gets. Yeah, absolutely. She brings up a really good point.
So when we're doing the designated beneficiary thing, if you want to do it most ideally, and you know you're in your late period, you create this other bank account that you put in your I'm dead now money. And it's got like 10,000. Yeah, and you go, that's to bury me, that's to pay the last bills that are available. Most of my clients in the last year of their life, they don't have a lot of bills. Right? Cell phone, La Posada. That's about it. Yes, ma'am.
One more.
Yeah.
A yes or no, to make it short for everybody. Have you heard of a portable will, and is that no?
Yes and no.
Okay.
Yeah, that's what I'm saying. There's a lot of stuff. People are going to go out there. They're going to try to make you afraid of things. Operate without the fear. Move forward. There's a bunch of stuff that we can do. It's going to be fine. Don't be uninformed. Don't. I'll tell you the thing. Has anybody ever spray painted anything? Right? Okay. How do you prep the can? You shake it. Did you hear that little sound? That's you guys. Joe said that thing about estates. He's got a phone number and an email, open 4 days a week. I'm gonna think about it for about a month. Why? Your curiosity should make the phone call, right? Then you call and we talk, and usually it's gonna get you a better place. I think that's my time, folks. Thank you very much. I really appreciate you all being here. Thank you.